So we move to Chapter 9, IAS 16, Property, Plant and Equipment. And you'll see from your reading of the study hub in this particular section that it's quite a significant chapter. And I think the reason for that is that there are so many different areas in terms of PPE, or property, plant and equipment, for the examiner to target, not just obviously the acquisition or purchase of an asset of some kind, but also depreciation, revaluations, disposals, etc., etc. So really, this chapter for me is an examiner's dream. This is a chapter that the examiner will target. And if you look at the number of questions in the OT section of our course, you'll see that there's a high number. So again, that gives you a good indication of where you need to lay your emphasis. So let's take a look at the first area, just remembering that, in terms of the core of many of these chapters, the double entry is key. So this first area of main issues, as it were, how do we relate this into theory and also think about the double entry side? So we'll see here that the key first issue is really the initial recognition of the asset at acquisition. So I guess what we're talking about there is the purchase. So we bring an asset, let's say a piece of equipment, into our business. We buy an asset. So we've got to record it, in some way a debit or in some way a credit. Outside of that, second area, more related to depreciation, number 3 as well, the determination of an asset's carrying amount. Now, what we mean by that is, in effect, the net book value. In other words, if we buy an asset today, in 5 years' time, that asset, allowing for the depreciation, is going to have a value. That is its carrying amount. And that carrying amount will obviously change year on year, mainly because of depreciation. There can be some other variables as well. But in essence, we're talking about the amount of the net book value in our financial statements. Third area, depreciation. Now we know that, I guess, depreciation is an allowance for fall in value, wear and tear, or indeed use. Fourth area, impairment losses to be recognized. In other words, some fall in value of the asset for whatever reason. Now, if we see or if we understand that a given asset's valueness has fallen dramatically, then obviously in line with being prudent and careful as we need to be as financial accountants, we've got to reflect that in the accounts. So we've got to adjust for that issue. So quite a few issues, or principal issues, if you will. Let's talk about the first one, the initial measurement. In other words, we acquire, we purchase in some way. Now, what can we capitalize? And what we mean by capitalize, what can we allow as asset value? Well, clearly the first area is the purchase price itself, obviously after any trade discount. Outside of that, certainly directly attributable costs. Now, notice the word directly. That's important, and it's an area that the examiner will target. So for example, maybe we have a cost that isn't directly attributable, so therefore that can't be included in the value of the asset that we capitalized. Note below, we'll look at attributable costs. What about the third area? Well, this is a little bit of an odd one in one sense, and we're making assumptions here, but perhaps the site itself, perhaps the place or location on which the asset is going to sit in some way. Let's say it's a piece of equipment, could even be a building or something similar. Maybe there's some costs associated with that, getting that location or that site restored or dismantled, etc., etc. Okay? So 3 main areas. Now, what do we mean by directly attributable costs? Now, here's where the examiner is going to come into play. Now, I'm not going to, read the list for you. I'm pretty sure that you can read the list yourself. What I'll say is this: there's quite a lot of variables here. Everything's from, so for example, professional fees, maybe a legal fee associated with the purchase, possibly maybe an assembly cost, maybe, as we said up top, site preparation, a variety of different things. And for me, I wouldn't be advising to literally learn this off now, to rote learn it, to memorize it right now. What I'd be doing is just sort of getting a feel for it. Well, all of these things in one way or another seem to be, or indeed need to be, linked to getting that asset into its location and indeed ready for use. Yeah, it's not something that's sort of peripheral. It's not something that's completely indirect, a tip that we paid the delivery driver, for example. These things seem to be reasonably tightly linked to getting the asset ready for use and putting it in place, whatever that is. So for me, it's the questions. Really, it's the exposure to the questions and seeing how the examiner presents information to you. But I think the key point outside of the list itself is noting this word, or trying to remember directly attributable. Sometimes we may need to take a guess, or we may need to use our common sense. Okay? Now, in terms of sort of categories of non-current assets and the types of assets that we'll see in a set of financial statements, obviously a variety. Land and buildings, obviously fairly significant, plant and machinery, equipment, F&F or fixtures and fittings, office equipment perhaps, or motor vehicles. So we're really talking about, sort of large, tangible, physical items. And indeed, when you look at a set of accounts, you'll see that more often than not, the more significant areas, the big numbers, are in the NCA area. In other words, the non-current asset area. Not exclusively, but certainly a large proportion of most businesses' asset base will be housed under non-current. Remember, non-current being in use, some sort of economic benefit after a 12-month period. Okay? Now, in terms of the breakdown, in other words, if we were to look at the breakdown of, let's say, a given business under non-current assets, we see the variety there that we've just run through. We see three columns. We see the cost, or if you will, the original cost. We see accumulated depreciation, back to that in a moment, and we see carrying amount. So really, as you look at a set of accounts over the course of, let's say, 1, 2, 3, or 4 years, you'll see these areas changing because, there'll be new plant and machinery purchased, there'll be new office equipment purchased, but also the accumulated depreciation over the course of time on each particular class of asset will obviously rise, and therefore the carrying amounts will fall. So really, what you're looking for, if you're asked to perhaps analyze NCA or analyze non-current assets in a set of financial statements, you're really looking to, okay, well, what was the original cost? What's the accumulation to date of depreciation? And therefore, what's the sort of rough estimate? Well, not so much rough, but what's the business's estimate of the book value or the net book value now? So in effect, the carrying amount really says, yeah, I know that you purchased all these assets over the last 10 years for 10 million. I know that you've had depreciation of 4 million. But the bottom line is, as of now, we anticipate that if we were to sell, the book values would be around about 6 million. We can't predict the future, but we're trying to estimate, aren't we, with our depreciation rates as to how assets will change or indeed fall in value generally over the course of time. Let's move on from there to the double entry. Now, again, as I've said, double entry is important for us. These aren't complicated for me. Let's look at cash acquisition. So we're purchasing an NCA of some shape or form for cash. Now, obviously, when we talk about cash, we're really saying from the bank account. Given that these are fairly large items, I wouldn't purchase a building with cash from my pocket. I'm talking about really a bank transaction. So how do we acquire a non-current asset, let's say a motor vehicle or a large piece of equipment, for cash? Well, we debit the individual NCA account, in other words, the asset. We increase the asset. Remember from our double entry rule, debit assets and expenses to increase them. What about the flip side or the credit? Well, we credit cash or bank. Why is that? Well, we're reducing the asset of cash or bank because we're expending money. How do we reduce an asset? Well, if we debit assets and expenses to increase them, we must credit them to reduce. So therefore, debit NCA, increase asset, credit cash or bank, reduce asset. Okay, so there's a cash acquisition, or if you will, a bank acquisition. What about a credit acquisition? Not too different at all. We're really purchasing something on credit. In this particular case, there's an assumption in this section of the study hub that it's on a loan. Yeah? So we've taken out a bank loan, let's say, to purchase a car. So the first entry, exactly the same. Debit NCA or individual NCA account. So increase the non-current asset. Yes, that's in line with my rule. Debit assets and expenses to increase them. What about the credit side? Well, we've got two credits here. In effect, we've got a bank loan credit, yeah, or let's say we've got a trade payables credit. So, if you will, if we were just talking about an outright purchase, for argument's sake, $50,000 we took out as a bank loan, and we purchased a car for that $50,000, it would simply be debit NCA, credit bank loan. Or perhaps if it was a credit purchase in terms of from a supplier where we were being allowed 30 days credit, it would just simply be debit NCA, credit trade payables. So no, it'll be either or rather than both. Okay, so that's a credit acquisition. What about the supplier payment if we were assuming that it was just simply a trade payable entry and not a bank loan? Well, pretty simple. We debit trade payables, i.e. reduce the liability or decrease the liability. Why? Because that liability has just been paid off, doesn't exist anymore. How is that? Well, because we have used our bank account. We've reduced an asset, so therefore we've decreased an asset. Back to our rule, debit assets and expenses to increase them, therefore credit cash or bank to decrease it. Okay? So that's a run through of a cash acquisition, a credit acquisition, and indeed a supplier payment for an NCA, all following our straightforward rule. Now, what about depreciation, section 2? Firstly, as mentioned up top, what do we mean by it? Well, I guess what we're talking about, to cut it short, is really use. We're talking about use of an asset, and where you use assets, that more often than not, obviously depending upon the asset, that asset's going to fall in value. So key definition from the hub, is an expense, yes, to reflect how much of the economic benefit associated with a tangible non-current asset has been used up in the accounting period. So again, what we're trying to do is between the start of the accounting period, let's say January 1st, and the end of the accounting period, let's say 31st of December, we're trying to assess how much use we've made of that asset and indeed how much it had fallen value. We're sort of trying to predict its end value or book value by allowing for an expensed amount of depreciation. Outside of that second part here is really the spreading of the depreciable amount of the non-current asset over its useful economic life. What do we mean by that? Well, that means the life that we're going to use it for. So, as we see here, if we had a cost, for argument's sake, $100,000, if we thought at the end of the life there was some sort of residual value. Now, for residual, we could just read scrap. So let's just say it's a car, for argument's sake, quite an expensive car at $100,000, but nonetheless, let's say that the car on a residual value basis or a scrap value basis was worth $5,000 at the end of 10 years. If we divide that by the useful economic life, for argument's sake, the 10, then in effect, we're going to get the value of depreciation, let's say, on a straight line basis. I'll explain what that means in a moment. So in essence, what this second part says is we're really trying to write off or expense an amount over the course of the life of the asset, to allow for wear and tear, to allow for usage, and to allow for a depletion in its value. It's certainly going to be worth a lot less at the end of 10 years, possibly zero, than it's going to be worth at the end of 2 years or 5 years. So in effect, that carrying amount, or the book value, will fall and fall and fall towards the residual value, for argument's sake, $5,000, or maybe the residual value is zero. Maybe we think that the car itself will have no value after 10 years. Okay, so that's the definition. What about the sort of calculations? Well, this is important for us, and hopefully from the study chapter you have a fix on the two different methods. They're not overly complicated, to be honest with you. First one, straight line, which is probably the simplest one. Second one, reducing balance method. Now, all we mean by those two is, with straight line, we're really looking to write off an equal amount over the course of an asset's life. So let's assume the asset was purchased in the example that we gave above, car, 100,000, 10-year useful life, zero residual value. So we're saying, using the straight line method, for argument's sake, it's going to be $10,000 per annum as depreciation charged as an expense in our accounts. Okay? Now that's a very simple example. With reducing balance, we'll see in a moment that that's slightly different, not overly complicated. Again, assuming no residual value. We're simply saying that we have an asset that is valued at cost of 100, and indeed what we're going to do is to apply a given percentage, let's say 10% in this case, to the reducing balance. So year one, 10% of 100,000, as before with straight line, and year two, 10% of 100 less 10,000. So in effect, 10% of 90,000. So you'll see that the reducing balance is slightly different, normally giving a slightly longer life. It depends on the asset. And indeed, we'll see questions that will really test your knowledge of the type of depreciation method that would be suitable given different types of assets. So actually, in the example that I've just given, i.e. the car, more often than not, we know, certainly if you've bought cars like I have, that in the first year, the depreciation tends to be very, very heavy. It could be 30, it could be 40%, and indeed tends to tail off. So actually the example of straight line for a $100,000 car maybe is not the right one, but you get my meaning. Different types of rates will suit different types of assets. Certainly computer equipment, for example, would probably suit straight line over a short period, perhaps 3 years, maybe 4, because we know that the end of computer equipment's life is worth really nothing, and it tends to have a short life. Laptops, desktops, etc., perhaps 2 to 3 years, maybe a little bit more. So those are the sort of two main methods, or at least an introduction to them. I'm hoping that you've worked the questions and indeed the activities within the chapter, so you know what I'm talking about. Now, in terms of the straight line method, basically, straight line is sort of simple enough. We're simply talking about the rate, i.e. the depreciation rate, times the cost of the asset. Obviously, watch for residual value. With the reducing balance method, slightly different. As we've seen, the carrying amount is used time the rate, not the cost. And that, as mentioned up top, tends to give, obviously, because of the mathematical side, a slightly longer life. Okay? So that's the two main methods. Outside of that, when we talk about, when we talk about the sort of double entry, again, I think this is fairly straightforward because I guess at this stage of our studies, we're familiar with the idea of creating an expense. And if you accept what we said up top, that depreciation is just an expense, then all we need to do is create it. That gives us the first part of the entry, i.e. the debit. Debit depreciation, i.e. increase the expense. Now, credit side, credit NCA accumulated depreciation. Now, it says that this is an asset account. Strictly speaking, it is, but it's more a sort of an offset asset account. And what I mean by that is, as you saw with the diagram up top, this sort of sits offset the NCA cost account to provide us with the carrying amount. So each year, or indeed each period, we must be crediting to accumulated depreciation to reduce the carrying amount of the asset. I mean, we've got to have a double entry. So if we're debiting to the P&L account and the expense, we've got to credit somewhere, and ideally we credit against the asset, as it were, to really reduce the asset value, or if you will, increase the accumulated depreciation value, which does the same thing. Okay? So that's fairly straightforward, I think, and if it's not right now, we'll get it by working questions. Do make sure that in terms of your run through all chapters, as I've said from the outset, that we are doing the activities in each chapter. Okay? In terms of our course, we can run through obviously the theory. We've got a lot of practice OT questions for you, but the activities themselves are your starting point really prior to the OT or exam question videos, and that's where part of your learning takes place. Okay, let's look at disposal here. Let me just get this in the right place for you. So just to recap so far, we've talked about really buying an asset. We've talked about sort of directly attributable costs. We've talked about sort of depreciation and carrying amounts, methods, etc., etc. What happens when we actually dispose? Well, what if we get rid of an asset? Surely we have to make some adjustments. Absolutely. So what are the elements that we should consider? Okay, well, let's think about it. If I purchased an asset 3, 4, 5 years ago, certainly the cost is in my account somewhere. Okay, absolutely, it's in there. Outside of that, certainly accumulated depreciation must be in there too, because I've been depreciating this asset for 3, 4, or 5 years. Next area, well, if I'm disposing of it, then someone external to the organization, this business, is providing me with sales proceeds. That's money coming in, I guess, to the bank account. And then outside of that, a combination of 1, 2, and 3 is going to be some sort of profit or loss on disposal. Now, in effect, what I mean is that if we have a carrying amount of an asset, as at now, and we dispose of it, there must be a difference between the sales proceeds and the carrying amount. It's not going to be exact. It's highly unlikely that we have all our carrying amounts of all assets exactly at the amount that we're able to receive if we sell them. So we've got to be able to account for these things. In other words, account for the cost that's in there, the accumulated depreciation that's in there, the sales proceeds that's just been received, etc., etc. So in terms of accounting for this NCA disposal, first things first, we need to be able to calculate the gain or the loss on disposal. And as just mentioned up top, number one, let's look at scenario number one. We have sales proceeds exceeding the carrying value. That must mean that there's a profit on disposal. Absolutely. What about the flip side? Well, sales proceeds, unfortunately, are less than the carrying amount. That means we've made a loss on disposal. It could work both ways. And remember, for exam questions, we need to be familiar with the mechanics of any scenario, not just one, not just a profit. Now, in terms of the little sort of diagram here, make sure you're familiar with how these little diagrams sort of, filter into debit and credit. More of that in a moment. But in essence, what we're sort of saying here is we're going to have journaled or brought in sales proceeds into the bank account, into the general ledger in some way, shape or form. We know that the carrying value is already in there, isn't it? Because we've got the cost in there and we've got accumulated depreciation. Really, the difference between the two must be, at the end of the day, the profit or loss on disposal. So what about the actual double entry itself? In other words, it's happening right now. The transaction is in play. We've just received the funds. Let's account for it. Well, first things first, we must remove the asset from the cost account. That asset is sitting as a motor vehicle, let's say, in NCA. It must be removed because it's just been driven off from our premises by the individual who bought the car. Outside of that, if the asset is gone, then the accumulated depreciation must be reversed out, must be removed, because we can't leave accumulated depreciation for an asset that doesn't exist in our business in the accounts. More of that in a moment. Third one, record sales proceeds. We've received, for argument's sake, $10,000, $20,000 into our bank account. We need to record it. And then the last thing, which is actually sort of, in one sense, drops out, but we do make an adjustment for it, is it says record the profit and loss. Well, the profit and loss is really the difference between the first three, isn't it? In some way, shape, or form. And we only know if it's profit and loss by doing the calculation. So what about the actual entries themselves? Well, let's deal with number one. Let me just bring this over so you can actually see it properly. Remove asset from the cost account. Okay, well, in terms of removing asset from the cost account, well, in one sense, although that is that the correct entry? Okay, that looks like the adjustment actually for the cash or for the sales proceeds. My apologies, that's the incorrect entry. What that should read is to remove an asset from the cost account must simply be to credit the asset or credit NCA and debit the disposals account. Okay, that double entry should be, credit asset, i.e. reduce asset, and debit disposals account. My apologies for that. I will change the mind map. So what does that do? Well, the asset's gone. It's gone from cost, and it's in, because we've removed it to the disposal account. It's in the disposal account, as we'll see in a moment. What about the next entry? Hopefully I've got this right. Remove asset from accumulated depreciation account. What we simply mean by this is we can't leave accumulated depreciation in a set of accounts where the asset has gone. So what do? Well, we must move it to disposal or the disposals account. So we debit the non-current asset accumulated depreciation. Why do we debit it? Well, we want to reduce it. It is a credit balance, remember. So by debiting it, we're reducing it and we're moving it to the disposals account. We credit disposals. So we have an entry on the credit side for all the accumulated depreciation. So let's stop there just for a moment with 1 and 2, because it may be I've confused you by not having the right image here. With 1 and 2, seems to me what we've done now, and I'm thinking specifically about the disposal account, is we've got a situation where we have, in the disposal account, we have the cost, as a debit, and indeed we have the accumulated depreciation as a credit. Ignore the credit disposal here, that's the wrong entry. So those first two entries basically remove those two items from our account and place them in the disposals account. What about the third entry? You recall up top, it was to record sales proceeds, which is the one I duplicated here. So what does that mean? Well, it means that money has come in. It means that the bank account has swelled to the tune of the disposal value, $10,000, $20,000. So therefore, we're increasing an asset. So therefore, we must debit it. Now, where do we credit? Well, let's credit, because remember, we need to calculate the profit or loss on disposal. Let's credit the disposal account. Okay, now that's a sort of a temporary account, really, that is used to house the first three entries. So moving from there, what do? Well, you'll recall up top, the fourth point is, well what's the end result? And that is to record a profit or a loss on the disposal. Remember, it can't be both, it can only be one. We're comparing the carrying amount of that car, let's say, with the disposal proceeds. And the bottom line is that it's either going to be a loss or indeed a profit. So as we see here, If the sales proceeds exceed the carrying amount, i.e. profit on disposal, the double entry, and we must make this because remember, we want to take the profit in this case to the P&L. We debit the disposal account, to offset that account, effectively close it down, and we credit in the P&L profit on disposal. Now, you might think to yourself, well, why not just leave it where it is? Well, this is accounting. This is the way it works. We want to have a trail of transactions, as it were, and we want specifically either to have profit on disposal shown in the P&L account, or as you'll see below, loss on disposal, because there's more information, isn't it? So we note that profit on disposal is an income account. Absolutely. It's a credit, a bit like a sale. I've made a profit. Let's show it as part of my credits in the P&L. The flip side is the reverse, i.e. sales proceeds less than carrying amount, must be a loss on disposal. Absolutely. What's the double entry? Have to do it, remember. Debit loss on disposal, expense. Well, if it's a loss, it's negative. I don't like it. It's a charge. It's going to reduce my profits, absolutely. So therefore, this expense has increased. Okay? So flip side is, to put it there, we have to credit the disposal account. Okay? In effect, to move it, as it were. Okay? Let's move on to revaluation. Now, just a quick summary so far. The right-hand side, we saw basic transactions. In the disposal area, section 3, a little bit more complicated because we have a series of steps, we need to get the logic right, etc. This would probably be the same in terms of maybe having to slow down a little bit. This is the area of revaluing non-current assets. You may think to yourself, well, what do you mean by that? Well, I simply mean that in certain circumstances, there may well be a situation where the market value of an asset, we think, is perhaps significantly higher than its carrying value, and we're at liberty to adjust for that within reason. Outside of that, we could revalue on a periodic basis. In other words, it may well be, let's call it something simple, like a building, in an area that is up and coming, a business area, let's say, and it may well be that over the course of 5, 10, 15, 20 years, we need to continually revalue that building. Okay? Perfectly reasonable and legit, subject to certain variables. Now, in terms of IAS 16 and revaluations, two possible policies, are permitted in terms of sort of subsequent measurement. And by subsequent measurement, I simply mean you buy an asset today, and then over the course of time, you adjust that measurement, or you decide, for example, that the business or the business asset needs to be revalued. Okay? Now, depreciation cost method is basically a method just centers on what you would expect. The original purchase cost of the asset is just simply depreciated over its life. Okay? So no revaluation there at all. Or perhaps the revaluation model. So on this basis, the asset is carried at a revalued amount based on its fair value. Now, for fair value, just read market value. Okay? Now, this is an alternative model. This would be very, very relevant to, as I've mentioned, things like buildings. Now, the revaluation exercise is carried out regularly to keep the carrying amount in line with the fair value. So if a business chooses this model, it's not like that they can do it once and say, well, we revalued last year, we don't need to revalue again. We've got to really consider it regularly, normally annually. Following a revaluation, the revalued amount of the asset is depreciated over its remaining useful life. Now, a word of caution here. The examiner likes questions in this area, i.e. questions where an asset is purchased, then it's revalued, and then it has to be obviously depreciated in some way, shape, or form. You'll see within the OT section of the FA course videos pertaining to OT exam questions in this area. Watch for them because they can be a little bit tricky, okay? And because they're tricky, the examiner will include them, highly likely. So, word of caution, revaluation model within the OT section of Chapter 9 questions important to us. Okay, now moving on from the sort of basic intro, as it were. In terms of this particular model, well, yeah, we're going to use the revaluation model, particularly in relation to our buildings. So, the following must apply if that is the case. Okay, now note first and foremost that all assets of the same class must be revalued. So I can't choose one building. If I have 10 buildings, then all of them must be revalued. Maybe one or two perhaps don't lift in value in any significant way at all. Fair enough. But they must all be considered for revaluation. Okay? That's point number one, all assets. Point number two is it has to be applied, this policy consistency. So really, you can't just do it 1 year and then revert back to the depreciation method above. You have to do it year on year. Outside of that, this fair value, or if you will, the market value, you can assess it or measure it reliably. It cannot just be, my friend told me that the building was worth 20 million. You've got to involve, for example, professional valuers or professional estimates of some kind. Okay, the carrying amount is revalued for the fair value only if the fair value can be measured reliably. Okay, now in terms of the accounting for revaluation, typically when assets are first revalued, this will be an upward revaluation. Generally, doesn't have to be, but generally. These assets still need to be depreciated. The revised depreciation is calculated on the revalued amount divided by the asset's remaining useful life. Remember what I said up top in terms of that caution or word of warning, the examiner. This is the area, and there's this idea, now we've got a revalued amount with a different useful life because there's been 2, 3, or 4 years. Now we need to recalculate our annual depreciation. Okay, so watch for that. So in terms of the double entry here, now there's a fair amount to do in this area of double entry for revaluation. So I will slow down a little bit. The 5 adjustments generally relevant to PP&E. The first one is obviously the upward revaluation of the asset. The second one, as you would expect, is the revised depreciation charge given the change. Third one, excess depreciation. I'll explain that in a moment. Number 4, upwards or downwards revaluation for assets previously revalued. And the 5th one, disposal of revalued assets. Now, this may lose a little bit in translation. Some of these words may not have sort of set with you yet, even if you've been through the chapter and done the activities. Let me try to open this up by walking down the double entry. And remember that, as we've said with more complex double entry areas, it's a little bit like riding a bike. We just keep doing the questions and just picking up snippets of knowledge here and there. Let's look at the first area, which is probably the most straightforward of each of the 5. I'm just going to make this slightly bigger for you, and indeed for me. So we're talking here in the first instance of this upward revaluation of an asset. So we've decided, and indeed we've been given, professional advice in some way, shape or form, that a particular asset, let's say a building, is to be revalued upwards by 1 million. Okay, so in terms of the adjustment within the accounts, clearly what we're going to do is we're going to debit NCA or debit cost. Okay, why? Well, we are increasing the asset to its revalued amount. So the building was worth 10 million. The valuer says, well, now it's worth 11 million. So we must increase the value by the relevant difference. So there's the debit, increase to debit an asset. Outside of that, this debit to accumulated depreciation, it says remove the total accumulated depreciation. Now, why is that? Because it looks like we're increasing an asset. Well, strictly speaking, we're not, because we know that accumulated depreciation is a credit, isn't it? It offsets against the cost of the asset. So what we're actually doing is we are reducing total accumulated depreciation. We have to get rid of that amount, because if we leave it there, then it offsets against the revalued amount. And that wouldn't be acceptable, because it means that we're not showing the asset at fair value. The difference is to this new account, and we haven't seen this before, the revaluation surplus. So this is an equity account. This is an account that sits at the bottom of our balance sheet or statement of financial position and really records any sort of credits in effect for revalued items. So this is to record the revaluation adjustment in the equity account for this asset, net of any accumulated depreciation. Okay? So we've created this new revaluation surplus account. So this was number one, upward revaluation of assets. What about number two? You recall we said revised depreciation. Okay, now what do we mean by that? Well, what we mean is that just because we've been asked to revalue an asset doesn't mean that it's not going to be depreciated, because we have to assume that our accounting policies are in play with every asset year on year. We can't just stop depreciating. So how do we do that? Well, not overly complicated at all, because we'll be given information in the question about the revised, let's say, useful life, or indeed possibly a change in the depreciation method or rate. So this depreciation journal is not anything different to what we've seen before. Number one, the debit. So debit depreciation expense. We are increasing an expense for the revised depreciation for this year. What about the flip side? Again, as before, where do we credit when we've debited an expense? Well, we must credit to accumulated depreciation. What's the explanation? Well, it says reduces the value of the non-current assets. That's what depreciation does, and we accumulate it over the course of time. So this entry, not any different to what we've seen before. What about number three? Now this area of excess depreciation transfer. What do we mean by that? Well, what we mean is that there may well be some sort of element of, excuse me, a difference in depreciation between the old asset and what we did from purchase date through to the revaluation date, and indeed the new asset going forward. So this excess depreciation transfer, you'll see here, it says debit revaluation surplus. Okay, so reduces the revaluation surplus account that is created when the asset is revalued, okay, and credit retained earnings, i.e. capital increases, yeah. So in effect, what we're doing in relation to the entry that we had up here, yeah, the upward revaluation, you remember that we, in effect, debited the cost of the asset to increase it, reduced accumulated depreciation, but then took the balance to revaluation surplus. What we're doing here, really, is we're transferring any excess to retained earnings. In other words, we're getting it out of revaluation and putting it into the retained earnings account. Now you might think to yourself, well, why? They're both reserves. Well, for the sake of completeness, what we'd like to do is to keep any revaluation surplus account clean, as it were, where it only sort of references the uplift. Now, what about the next area, number 4? Upwards, downwards revaluation on previously revalued assets. Now, this is a little bit tricky. Let me walk through the double entry sort of slowly, as it were. The first entry says debit revaluation surplus. So in this case, what we're doing is reducing the revaluation surplus by the revaluation adjustment. Okay, the adjustment that we spoke about top. Yeah. Outside of that, in terms of the debit, to accumulated depreciation, we have to remove the accumulated depreciation as well. Okay. Now, the net effect of that is to cost. So we're reducing asset to its revalued amount. So in effect, what we're talking about is the reverse of what we've seen up top. Okay? A little bit tricky, as I've said. Working the questions is going to make us sort of focus in on the little nuances here. What I would say is, more often than not, the OT questions that you will face will be in the areas of either 1, 2, and 3 rather than this area. Okay? Now, in terms of this final area, this is quite, well, reasonably straightforward: disposal. So we're saying that we're disposing of a revalued asset. What do? Well, nothing too much at all. All that we're saying there is you have an asset. We saw up top that we use a disposals account. When we dispose of assets, you're going to use that again. But note, the difference is the balance that remains in the revaluation surplus account is transferred to retained earnings, as the gain in relation can now be realized with the sale of the asset. So in effect, what that means, and that's quite a lot of information, I understand. In effect, what that means is that we must strip out from the accounts, if we have some form of gain still left on the revaluation surplus account, we must really realize it, i.e. push it into retained earnings, because the asset is no longer in the business. So what we don't want is this asset, which has now been sold, was revalued. We don't want it reflected in cost of NCAs. We don't want it reflected in accumulated depreciation, and we certainly don't want it reflected in the revaluation surplus account. We want it, in effect, realized into retained earnings. Okay? Now, in terms of sort of the detail here, this relevant information is, that's actually on disclosures. And again, as we said in relation to disclosures, more often than not, disclosures are just what do we not disclose. We really disclose just about everything. Okay? Now, this is a slightly different area. We've talked so far about just about every practical aspect of NCAs, depreciation, directly attributable amounts, double entries, etc. This is a more sort of periphery area. The register, the non-current asset register. So not really sort of double entry related. It's more, this is a standalone memorandum document, where each asset that the business owns is listed, and it will include information on all activities relating to the asset. So what exactly do we mean? Well, what we mean is that it's preferable and indeed practical, essential for a business to list outside of its general ledger every single asset that the business owns. How do they do that? In this register or memorandum. Think of it perhaps, and I've seen it work in many ways, but certainly in terms of, let's say, a spreadsheet, a pretty comprehensive spreadsheet, that is adjusted from time to time as assets are purchased, sold, etc., etc. So note, as we see here, this particular register or memorandum is going to have just about every piece of information that it's possible to have in relation to each asset in the business. And you think about it, if we're talking about large entities, they may have thousands and thousands of assets. They need to have a way of obviously controlling them and indeed checking on them. So you'll see the list here is pretty comprehensive. Is there anything that isn't included in that list? Not really. Everything is in there in the register relating to every single asset that the business has purchased over the course of time. And even when the assets are sold, obviously, there'll be a record of that too. So let's remember what the non-current asset register actually is. Okay? In terms of disclosure, as I said up top, disclosure is probably for me the simplest area of the FA course, because when we think about what we've been through in each of the sections so far, certainly we need measurement details. We need methods, i.e., let's say, straight life versus reducing balance. We certainly need useful life, Outside of that, gross values, then reconciled amounts, and that will be a function of several things, as you would expect: additions, disposals, increases, maybe a revaluation, etc., etc. Okay? So that concludes this particular chapter. Quite a long one for us, IAS 16, but a good one. And as I said from the off, certainly a very, very examinable one as well. So I hope that made sense. You'll work the questions and get better and better and better. Thanks for listening.